Welcome. Thank you so much for joining us for Show Me the Money, an introduction to finance documents for arts funders. My name is Jamie Sharp, and I am the program manager here at GIA. I use she, they pronouns, and I'm a light-skinned Black femme in my 20s. I have natural hair, pink earrings, and a floral shirt on today. GIA is headquartered on the unceded land of the Lenape and Wappinger peoples. We ask you to join in acknowledging the Lenape and Wappinger communities, their elders, both past and present, as well as future generations. This acknowledgement demonstrates a commitment to beginning the process of working to dismantle the ongoing legacies of settler colonialism. Before we begin our webinar, please take a minute to review the Zoom features so that you have an optimal experience with us today. If you have a question for our team during the webinar, please feel free to use the chat function and message LGC Tech. Otherwise, you can use the Q&A feature at the bottom of your screen to submit questions for the presenter. If you would like your experience to include live captioning, please select the closed caption or CC feature in the toolbar at the bottom of your screen and select Show Subtitles. Often, we hear from grants managers and program officers that they wish there was an introduction to finance documents that they review in their arts and culture funding work. Well, here it is. Designed for non-finance professionals, today's webinar will review profit and loss statements, trial balances, and what they can and cannot tell about an organization's finances. We'll also touch on the federal Form 990 tax return for nonprofits and a basic cash flow projection. Financial documents can be intimidating, but we have GIA's own Director of Operations and Finance to help you develop a basic familiarity with the information they contain so they'll be a little bit less scary. And with that, I will hand it off to Champ.
Hello, everyone. I'm tempted to say good afternoon because it's afternoon where I am, but I know it's not afternoon where everyone else is. Before we get started, I want you to drop your answers to this question into the chat. What scares you the most about looking at financial documents? Or what is it that motivated you to join this webinar this afternoon? I'll give it a couple of minutes. But while you answer that question, I am going to introduce myself. I am Champ Knecht. I use he, him pronouns. I am a middle-aged white man with a goatee and glasses and close-cropped / balding hair, and I'm wearing a brown, blue, and orange shirt today. I am the Director of Finance and Operations for Grantmakers in the Arts and have been since 2018. I've got a little bit about my past experience here on the slide. I've worked prior to GIA for a number of art museums, but down at the bottom, I've included the fact that I have a degree in English literature. So what I have learned about finances and financial documents has been learned through my career. The point I want to make with that is that if I can master this kind of information, so can you. It's not as daunting as it might appear when you first look at it. I'm looking at the responses here in the chat. Not being financially literate enough to understand arts funding, being afraid that something will be misinterpreted, understanding what's behind the numbers, being able to master a lot of information, overlooking some red flags that might be presented in financial documents. That's all good information, and hopefully you will come out of this workshop this afternoon with a better grasp of what you can see in financial documents and what you can't necessarily see. These are the documents that we will go over this afternoon. The profit and loss statement, or P&L, the balance sheet, the federal Form 990, and the cash flow projection. We're going to spend most of our time on the first two, the profit and loss statement and the balance sheet, because those are the two crucial financial documents for most organizations. There is some important information that you can gather from the 990. The financial information on the 990 is generally presented in a more easily understood format in the first two documents we're going to talk about, the P&L and the balance sheet. But there are a couple of things that the 990 can tell you that you wouldn't have insight into otherwise. And then cash flow projection, I just want to touch on because it's another crucial financial document. It's not really useful for analysis of another organization. It's much more useful internally for the management of an organization. Before we get into the meat, I want to let you all know that we are going to be using the Q&A function this afternoon in this webinar, or today in this webinar. And it's right next to chat down at the bottom icon bar. If you have questions as we're going through the material, you can drop them into the Q&A. I have enlisted a friend and colleague of mine to monitor the Q&A. Glyn Northington is a former board chair for GIA. Glyn spent many years at Propel Nonprofits, which is an excellent organization that provides services for nonprofits in areas like governance and strategy and finance. Also, and most germane to today's workshop, Glyn was GIA's treasurer for 6 years. So he could probably be doing this workshop without me, but certainly he is in a position to answer some questions in the Q&A that are maybe something that I have left unclear, or to reiterate something that I may have covered a few minutes ago. If there are more substantive questions, he'll bring them to my attention so that I can address them within the course of the webinar. So just use the Q&A rather than the chat if you have questions. And there will be a Q&A portion of the workshop, the webinar. I'm going to say workshop and webinar interchangeably today, but there will be an official Q&A later on. Okay, let's get right into it. The profit and loss statement, which is an organization's principal budget performance document. Oh, one other thing that I forgot to mention. I know that a presenter reading slides is not the most engaging way to conduct a webinar, but I have made the choice to make the slides very information heavy because I suspect that many of us will want to have the slides as a resource to use weeks and months from now. And I suspect that some people may have registered for the webinar this afternoon just to have the slides as a takeaway. So I've tried to make the slides as useful a tool as I can, which may mean that I'll do a lot of reading of the slides, and I apologize in advance for that. So the profit and loss statement is sometimes referred to as an organization's budget. It is a budget performance document. Oftentimes it's one page. This is an example of GIA's profit and loss statement. It is 2 pages. We put revenue on one page and expenses on the other, but many organizations put both together on one page. It tracks your annual budget, where you are at the current point of the fiscal year, and in some cases, where you expect to end up if you think it's going to be different than the approved budget that you have. What can a P&L statement tell us about an organization? Well, first off, it can tell you what the organization's operating budget is. You can look at the quote unquote bottom line to see how much an organization is expecting to spend on its operations in the current fiscal period, which is generally the fiscal year. Um, you can also tell how much of what types of expenses an organization has. Um, Personnel expenses, salaries, benefits, bonuses, other personnel type expenses, and then how much does it spend on what we sometimes in finance call OTPS, other than personnel services. So things that are not related to personnel. And you can tell the balance. Is this organization spending more on personnel than on non-personnel? Is it spending more on programs than it is on salaries, etc.? And of course, because it is a budget performance document, you can tell how well or badly an organization is doing relative to its budget. Whether it's overspending in some areas, whether it's underspending in some areas, whether the budget itself was not a particularly well thought out budget, and the way that the expenses are actually occurring, the way that the revenue is actually coming in, it bears very little relation to the budget, which is an insight into the management of an organization and how well the management knows the finances of its own organization. You can also tell if the budget is performing badly because of unexpected external factors like a revenue shortfall or unexpected expenses. The P&L won't give you a tremendous amount of insight into what the explanation of cost overruns or revenue shortfalls is. But you should have a relationship with your grantees where you can ask them about it. It will highlight particular expenses or revenues that are out of sync with the budget and give you talking points or questions to go to your grantee organizations and ask about. A budget is a statement of an organization's priorities. This is a thing that we say all the time at GIA. We did not coin this phrase. Lots of other organizations talk about a budget as a statement of an organization's priorities, but it's something we very strongly believe at GIA. What we mean when we say that is, what is this organization spending most of its money on? Because the things that are most important to you are the things that you're spending most of your money on. What does this organization call out in its budget as expenses that it wants to keep track of? One of the things that I can point out when we get further into GIA's budget as an example, we do not currently have a line on our budget for professional development. We spend money on professional development, and that money shows up on our P&L within a certain category that we call outreach, but we're not breaking it out as professional development. And we have determined this year that we really should do that, because it is something that we feel strongly about. We support the development of our team members. And if we feel strongly about it, we should break it out and show that on our budget, that this is a line that we want to put money into because we want to support the development of our team members. So that is what we mean when we say a budget is a statement of an organization's priorities. You can tell what's important to that organization when you look at where the money it is spending is going. Okay, this is a screenshot of the revenue page of GIA's profit loss statement, P&L, from December 2022. I chose that year to use as an example simply because it's the most recent year that we have a completed audit for, and it is not the current budget year, so I'm not revealing anything about our current budget. This is historic information. But I wanted to show you how GIA lays out its profit and loss statement. We've got various types of revenue. This section, this top section, is the contributed revenue, and this bottom section is our earned revenue. And there is a definite distinction made between contributed and earned, and I will go through that in just a second. Before I do that, though, I want to do a little sidebar about the terms income and revenue. Many organizations will use them interchangeably, and for purposes of today, they are interchangeable. Income is revenue, revenue is income. But financially, there is a distinction. Revenue is simply money that is coming in the current fiscal period. It becomes income when expenses for the same period are subtracted from it. So if you have $100 in revenue and $75 in expenses, you've got $25 of income, because that is money that has been made once all of the expenses are netted out. So that is the distinction between revenue and income, but it's an accounting distinction. It is not a layman's distinction. So most of the time, you'll be able to use those two terms interchangeably, income and revenue. There are two principal types of revenue that you'll encounter in a nonprofit organization: contributed and earned. Sure, I see that somebody just dropped into the chat about the distinction between revenue and income. Sure. Revenue is money that is coming in without any encumbrances on it. It's just money coming in. Income is money that you can keep that will go into your bank account after you've netted out all of the expenses. So revenue can be seen as gross and income can be seen as net, if that helps to explain the distinction. Okay, so we're going to go back. Two types of revenue: contributed and earned. Contributed revenue is gifts and grants. It is money that comes in that is not in exchange for anything. It is just contributed to your organization with, there may be restrictions on it, but it is not in exchange for any goods or services. Your organization has not provided anything in order to receive this revenue. Earned income, on the other hand, is money that is coming in to your organization in exchange for goods or services. It's ticket revenue. It is fees for a conference, for example, which is something that we're 100% working on right now at GIA with our conference coming up in less than a month. It's registration fees for webinars. It's money for consulting services. It's membership dues. It is money that someone is paying you in exchange for you doing something for them or giving them something. And the reason that there's a distinction between contributed and earned is that earned revenue comes with a cost that contributed revenue does not. So if you're making money from ticket sales, there is a cost of the production or the performance that this is a ticket to. And you want to net out what the cost is of the service or the goods that you're providing in order to determine how much you actually made in income from that earned revenue. A big issue that you will encounter in nonprofit revenue is restricted versus unrestricted revenue. And I should say that this is much more of a concern in nonprofit or not-for-profit organizations. This type of accounting that we're going through today is not for-profit accounting. There are distinctions that are made, and one of the big distinctions between for-profit and non-for-profit is this question of unrestricted versus restricted revenue. Unrestricted revenue is revenue that can be used for any purpose that the management of the organization thinks is appropriate. So it can be used to pay salaries. It can be used to pay rent or utilities. It can be used to cover travel. It can also be used to pay for program expenses. You're not prevented from paying program expenses with unrestricted revenue. Unrestricted revenue can be used for program expenses and other expenses as well. It provides a lot of flexibility on the part of management to use the money where it's most needed. Restricted revenue, on the other hand, is revenue that you have gotten for a specific purpose. One of the most common is grants. You get a grant that is to fund a particular program, a performance, an exhibition, a workshop, etc. And you can only use that revenue to pay for that program. Oftentimes in the presentation world, in the museum world that I came from before I came to GIA, you would get contributed income from individual donors, and it would be given for a specific purpose that was often very restricted. You could only use it to pay for this educational program. You couldn't use it to pay for salaries or overhead expenses that you incurred in presenting this program. You could only use restricted revenue for that specific program. Many foundations and other types of arts and culture funders are allowing greater flexibility within restricted revenue. So for example, you might have a grant that is for a particular program that also allows you to pay for some portion of staff salaries that applies to that program, some portion of facility expenses like rent or mortgage and utilities that applies to that program. And we like to see this greater flexibility. The ideal is to have all money unrestricted so that it can be used at the discretion of the management of the organization. That said, restricted revenue can provide some stability for an organization. If you get a 3-year grant to pay for a particular program, you know that you're going to be able to do that program for the next 3 years. And that's not necessarily a bad thing. But unrestricted revenue, because it is more flexible, can be more useful to an organization. So one of the things that we stress at GIA is that as much as possible, it's better for arts and culture funders to give unrestricted revenue or be as broad in their restrictions as they can. And that is something that you will hear us talk more about in the capitalization work that we do. We do a series of workshops on sound capitalization strategies for arts and culture funders and for nonprofits. We have one coming up at the end of October, October 30th, and I would recommend that anyone who is at least moderately interested in what we're talking about today join that, because there's tons of useful information that can be gleaned from that as well. And I will refer to our capitalization workshops a number of times today. Now, just because the distinction between restricted and unrestricted revenue isn't complicated enough, there is a question of the release of restricted revenue. Restricted revenue can only be used, as I said, for specified purposes. And sometimes that means that that revenue needs to be held by an organization for a period of time because it's not engaged in that particular purpose right now. Or it can be held because revenue has been given that is restricted for time. Within accounting, we restrict revenue for purpose or time. If you get a general operating support grant that is for next year, you can't use it this year. So you have to hold it until you enter into the time period for which it's intended to be used. Restricted revenue that was given in a prior period is considered released when the appropriate period for its use is entered, or when the purpose for which it was given is occurring. So if it was given to support a performance, when that performance is occurring, you can use those funds. Or if it was given for an exhibition, to support an exhibition, you can use it when that exhibition has opened and is mounted. That's considered released money. So I'm going to skip back for a second to the example P&L that I gave of GIA, and you can see that we have restricted monies on here. So for example, people will give us, organizations will give us money for our conference. And it's restricted just to be used for the conference. Sometimes they will give us money for the conference ahead of time. In fact, we like it when they give us money for the conference ahead of time. But that means it is restricted and can only be released when we're actually working on that conference. So we break those monies out on our P&L to show this is revenue that's been earned in the year, the restricted revenue. Restricted released is money that has been earned in a prior period that can be used now in the current fiscal year. Accounting rules require that when you receive funds, you need to post them at that time, even if they cannot be used until a future period or a future point in time. So we have to show that money was earned in 2024 that can't be used until 2025. It gets shown in 2024 on our balance sheet as money that is in restriction, and then it gets shown next year on 2025 as money that has been released from restriction and can be used in the current period. Now we're going to go to the expense portion of the P&L. This is from the same December 2022 P&L that belongs to GIA, but this is an example of how we present our budget, our expenses. When somebody asks, what is an organization's operating budget? This is what they mean. What does it cost to run this organization? What are the expenses? And if you look through this list of expenses, you will see that we don't have a professional development line. We will in 2025, because that's something that we're working on right now. We do spend money on professional development in this outreach line, but we're not calling it professional development. And we should, because it is a statement of our principles, right? This is our budget. And we want people to know that that is something that GIA values. As I mentioned, the expense portion of the P&L is what people mean when they say, what's your organization's budget? How much are you spending? And then they'll want to know, how are you paying for it? But when they say, what's your budget, they mean, what are your expenses? Now, each organization presents their expenses differently. There are certain general ideas that you want so that one organization's budget can be compared to another's, but at minimum, an organization should show how much it's spending on personnel expenses and how much it's spending on things that are not personnel expenses. It's useful to have greater detail than that, but at minimum, that's what it should be showing. It's useful to see how much an organization is paying on its facility, how much it's paying for specific programs. I'm going to stop here for a second to editorialize for a minute. I realize that probably most of you don't have a lot of control over how grant applications or grant reporting is done within a funding organization. But the amount of time that a person in my position spends taking our budget and dividing it up according to a funder's template for expenses is crazy. It would be wonderful if there were some sort of standard reporting form or application that most arts and culture funders used, because I am constantly rewriting our operating budget based on what a funder's application template or reporting template is. And it's all the same budget. It's all the same bottom line. I just have to slice it and dice it a different way each time. And I will step off my soapbox right now. You will hear people talk about overhead expenses when we're reviewing a P&L. Overhead are expenses that are incurred by the organization for all of the things that it does. It can be facility expenses like rent or mortgage payments if you have them, utilities, telephone, internet, your office operations, your copier machine lease if you have one, your insurance, your taxes if you have to pay taxes. At GIA, we are now a fully remote organization, but not too long ago, we had to pay rent. And part of our lease agreement was that we would have an amortized amount of real estate taxes that we had to pay we had to reimburse our landlord for. So even though we're a tax exempt organization, we still had to pay a portion of real estate taxes as part of our lease agreement. If you have outside accountants, or if you have an audit, if you pay for legal representation or legal advice, if you have a tech support company, a managed IT company, these are all overhead expenses. Some funding organizations will allow you to pay an allocated piece of overhead expenses as part of a program grant, but not all organizations do that. It is very useful if they do, because you may be doing a program that is, say an education program, for example, but it requires staff time. It's taking place in your facility. You are incurring expenses that are not directly charged to the program. They're not supplies or artists' fees or consulting fees, but they are necessary expenses or expenses that are necessary to executing the program. And so it makes sense that some of those overhead expenses should be paid for in programming grants, but not every funder allows for that. Many organizations, many nonprofit organizations, including GIA, are required or even if not required, produce an annual audit each year. Not all organizations are required to, and not all organizations do, but many do. And as part of the annual audit, we produce something called a statement of functional expenses. That statement takes our overhead expenses and allocates them across 3 different areas of activity: our program expenses, our fundraising expenses, and our administrative expenses. At GIA, we do the allocation based on a percentage of staff time devoted to each of those areas of activity. And it varies from team member to team member. You know, our membership manager spends most of her time working in the area of fundraising, whereas our vice president and director of programs spends most of her time working on programming. So we do the allocation based on a reported percentage of staff time so that we can present this schedule that shows how much Grantmakers in the Arts is spending on fundraising, how much it's spending on programs, how much it's spending on administrative activities, including how much staff time is devoted to that, how much rent is devoted to that, how much copier lease is devoted to that. Some funders might have a percentage that they want to see devoted to programming in particular, but this allocation can be useful to show whether an organization is spending what you deem an acceptable amount of time and money on administration, or whether it's spending more time on programming. So that is a brief run through the P&L. And I'm going to pause for a second just so that I can take a drink of water and look at the chat and Q&A and ask Glenn if there's anything that I should lift up into the room at the moment specific to the P&L before I move toward the balance sheet.
Camp, I do think it would be helpful because some of the organizations are asking about contracts versus earned or contributed, and what is a contract considered earned or contributed, since their contracts are one of the things that some of the organizations are involved with, and there's often a term you hear related to government funding.
Yeah, government funding can sometimes be its own complicated entity. But contract revenue is typically considered earned revenue, because in the ordinary understanding of a contract, there's 2 sides. Someone is going to give you money, in this case, the government, and you are going to do something for them in order to fulfill that contract. You know, there are 2 sides that need to provide something. Whereas in a grant, for example, even though you often sign a contract for a grant, you are not providing the funder with anything for that grant. They're giving you a grant, sometimes for a specific purpose, and all you have to do is execute that purpose. Contracts are much more in the realm of earned revenue because there is something that you have to do in order to meet the terms of that contract. And if you don't meet the terms of that contract, then the funder does not have to provide you with the money or can ask for the money back if they gave it to you. I don't want to go too far into the weeds on this, but there was a big change of accounting rules a couple of years ago, specifically regarding contract income, or oh gosh, the term is escaping me. But we had to start listing a lot of funding that had been listed as restricted as a different balance sheet category, and we're about to get into balance sheet, called deferred revenue, because there was a contract relationship set up, and the revenue could not be considered realized revenue or released revenue until the stipulations of the contract were fulfilled. So contracts fall into the realm of earned revenue. All right, the balance sheet. I started with the P&L because I think it's a bit more intuitive. I mean, most of us are used to at least the concepts of a budget, even from just our own household finances. The balance sheet has a lot of terminology that is less familiar, but the P&L, having an acquaintance with the P&L can help you understand the balance sheet a little bit better. Balance sheet is going to tell you what an organization is worth. It's really designed to show what would happen if an organization ceased operations today, what would be left? And I'll explain exactly what I mean by that when we get into it. This is GIA's balance sheet from the same period that I'm talking about, December 31st, 2022. Ours is a comparative balance sheet. So we have the current year and we have the immediately preceding year. What can a balance sheet tell you about an organization? What is the organization worth? How liquid is the organization? And by liquid, we mean how much cash does it have on hand to meet its obligations, and how readily any non-cash assets can be turned into cash. What debts and other obligations does an organization have? And with a little bit of analysis, you can look at whether an organization has more obligations, more debt than it is capable of funding, or not. And the bottom line on a balance sheet can tell you if an organization in its current activities is adding to the net assets of the organization or subtracting from it. So here's what I mean when I say the P&L can give you help you understand the structure of the balance sheet. We looked at the P&L and it lists revenue, subtracts out expenses, and it tells you what the surplus or deficit is. The surplus would be income, as I mentioned before, money that you've earned at the end of the fiscal year or whatever period the P&L refers to. So just in the same way, the balance sheet is set up to have assets, which are things of value that belong to an organization, less liabilities, which are in some cases expenses, and in some cases not necessarily expenses, but they are things that are subtracted from the assets. And then the bottom line, what we would have as a surplus or a deficit on the P&L, is the net assets, or sometimes called equity. It's usually called equity in the for-profit world, because that is what could be distributed among shareholders. In the not-for-profit world, we call it net assets because we don't have shareholders. We don't pass that money on to anybody. It is money that is retained by the organization. Assets are things that an organization has that has value, and I think most of us are familiar with the term assets. Current assets can be cash and cash equivalents. Restricted cash, if you want to break out what's restricted versus what's unrestricted on your balance sheet, GIA does not do that. Investments, petty cash, accounts receivable, and contributions receivable. Some organizations combine those two. Some organizations break them out separately because accounts receivable would be earned income and contributions would be contributed income. Prepaid expenses are an asset because if you have paid an expense ahead of time, that's one less thing you have to worry about when you get to the period where to which that expense relates. In GIA's case, for example, we often have to do site visits planning our conference that happen ahead of the conference. So those are considered prepaid expenses, something that we don't have to pay for when we're actually doing the conference. And inventory. I mentioned that I used to work in museums, and many museums have a bookstore or a gift shop. That inventory is considered an asset because it is something that the organization earns that has value. Fixed assets, another category of assets, are your stuff, your building, your land, your furniture, your equipment. And then long-term assets are long-term investments and intangible assets. Some organizations have patents or have intellectual property rights to performances or to literary rights. Those are also assets. They are things that belong to the organization that have a value. They are not tangible, so they are not counted as current assets or fixed assets, but they are assets of an organization. Now, we'll go a little bit more into detail on current assets, but the rule of thumb for current assets is that they could be converted to cash quickly within a year. And that's what we mean when we say something is liquid, or we talk about liquidity. It's how quickly can it be turned into cash? Because cash is the most liquid thing that you can have. And here are the various types of current assets: cash and cash equivalents, restricted cash, investments, unless they're long-term investments. Typically, if you have investments, if you need to, you can sell them rather quickly and get some return on them. So they are considered more liquid. Petty cash, accounts receivable. Now, when we talk about accounts receivable, what we mean is money that has been promised to the organization that you haven't gotten yet. In the case of GIA, we're a membership organization. A lot of organizations ask us to invoice them for membership dues, and then they pay them later on. Once we invoice them, we put it on the books as an accounts receivable, and then when the money comes in later, we close out that accounts receivable. But it is considered an asset to the organization, even if we haven't received it yet, because it's money that we're owed and we have every right to collect on it. Contributions receivable is the same thing, except for contributed income. So if we get a grant award letter dated in June that says we're going to give you this money in November, we put it on the books as a contribution receivable effective June, and then we close out that receivable when the funds come in November. I'll skip over to fixed assets. Now, fixed assets are things that have a useful life of more than a year. And I've kind of gone through a lot of these: property and land, furniture, fixtures, equipment, and that extends to equipment that an organization may need to realize its mission. So if it's a performing arts organization, they may have stage lighting. If it's a museum, they may have display units. Those are all things that have some value and should be carried on an organization's books to say, this is everything that the organization has that is of value. And then, we've talked a little bit about long-term assets, the intangible assets like patents or rights to choreography or intellectual property. The intellectual property of this workshop, for example, is an asset that GIA owns. There is a category of long-term assets that I've not included on here because it's specific to certain types of organizations. It's called capital assets. And what I'm specifically thinking of is if the organization is an art museum, the art museum may own art. That is an asset. It's a tangible asset. It's not intangible. It's not a current asset. It's a long-term asset. So it's a subcategory of long-term assets called capital assets. When you have something like that, and again, I'm thinking specifically of an art collection, but this also applies to intellectual property and rights to art pieces, performance pieces. In order to carry that on your balance sheet, you should have some sort of outside appraisal to tell you what the value is. We don't like to rely just on an organization saying, hey, our art collection is worth $3 million. There should be some outside authority who says, yes, this art collection is worth $3 million. So if you carry something like an intangible or a capital asset on your balance sheet, you want to have an independent appraisal telling you what the value is. That's not really applicable to many organizations, but it is something that does come up from time to time. Fixed assets and depreciation. Okay, you've got a building, you've got computers, you've got office furniture and desks and chairs, and all of that was worth something when you bought it. You paid X amount of dollars for it. But that was 5 years ago. It's not worth the same thing now that it was 5 years ago. And in order to have an accurate balance sheet, you want to reflect that these physical assets do depreciate over time. The IRS has a depreciation schedule. Many organizations work with an accounting firm to draw up a depreciation schedule because different things lose value at different rates. Your building doesn't lose value as quickly as your laptop computer does. So oftentimes the depreciation on an addition to a building, we're not going to say the building itself, but in addition to a building, might be 30 years, whereas a laptop might be 5. The total amount of the depreciation schedule for the current period should be carried on your balance sheet as a negative below the fixed asset line. This is getting a little complicated, and I don't have an example to show you because Grantmakers in the Arts doesn't have fixed assets, doesn't retain fixed assets, and doesn't do a depreciation schedule because of that. But if you have on your balance sheet a positive number for your fixed assets, $1 million, You should also have right beneath it a negative number that says these fixed assets have lost X amount of dollars in value since they were added to the fixed asset category, so that the net amount is what's considered your fixed asset value. And we can come back to this if it's a little hazy still. Now we're moving to the other category of items on a balance sheet. So we've got the assets, remember, at the top. Liabilities are below, and those will be subtracted from the value of the assets. They're debts, essentially, and other types of obligations, but you can really think of them all as one kind of debt or another. Accounts payable, which is bills that you've received that you have to pay. Payroll liabilities, which is, most of us don't get paid the day that we do the work. It's very common, for example, to have a payroll schedule that's every 2 weeks. Well, people have worked for 1 week and not yet been paid for it. So that amount that they should be paid for 1 week that they haven't been paid yet is considered a payroll liability. Loan interest is a liability. Unpaid insurance, you get an insurance policy that covers the whole year. You may not have to pay the whole thing all at once. The amount that's not paid is a liability. Accrued expenses. Now, accrued expenses is it's a category of expenses that honestly confused me for a long time, because many accrued expenses could be considered accounts payable. The difference usually is that accounts payable are expenses that have been incurred that an organization has been billed for. You have an invoice for it. Accrued expenses are expenses that you have incurred, but you don't have a bill yet. So you're kind of just putting a marker on your balance sheet that says, I know I'm going to get a bill for this trip. I don't have it yet, but I know it's going to be $5,000. So I'm going to put that on here as a liability. And then when I do get the bill, I will move it to accounts payable. Deferred revenue, which I mentioned earlier, which is revenue that you have in hand, but you can't use because it's deferred for a specific time period or purpose. And then short-term loans. If it's due within a year, that's considered a short-term liability. Long-term liabilities are things like your mortgage, the part that does not apply to the current year, or long-term loans that do not apply to the current year. And this slide actually just breaks down in text what I've just gone through verbally. All right, so when you have taken all of an organization's assets and subtracted all of its liabilities, you have a bottom line. That remainder is known as an organization's net assets, or as I mentioned in the for-profit world, equity. If you've got positive net assets at the bottom line, that means the organization has enough assets to meet all of its obligations, and there'll be something left over. If the organization were to close that day, those positive net assets are what would be left. Negative net assets mean that an organization doesn't have enough funds to meet all of its obligations, and that's a big red flag. A change in net assets. So if you have a balance sheet that shows 2 years, like GIA does, you can see if the net assets have changed from 1 year to the next, positively or negatively. And you can determine from that the organization is either adding to its assets in its current operations or taking away from its assets in its current operations. And that's useful information to know. As I mentioned earlier, net assets can have restrictions or be unrestricted. Net assets without restrictions, or unrestricted net assets, are assets that can be used for any purpose that the organization's management deems appropriate. Assets with restrictions cannot be used for any purpose. They have to be used for specific purposes or in specific time periods. And accounting rules make you make the distinction between how much you have in net assets that are without restrictions versus how much you have that are with restrictions. I saw a question pop up on my screen about deferred revenue. Deferred revenue is similar to temporarily restricted assets, but it's not exactly the same. Deferred revenue has conditions that have to be met. In some cases, those conditions are the same as restrictions, but not always. It often deferred revenue has to do with contracted revenue, where there is a contract that says you need to do X things. You need to, feed 100 school kids. And if you don't feed 100 school kids, you only feed 75. You have to give us back some of the money that we gave you to feed 100 school kids. So deferred revenue is often associated with contracted earned income. All right. The ultimate point of all of this is that the bottom line is not the whole story. You can look at a P&L, you can look at a balance sheet and get a sense of what is going on with an organization, but it doesn't tell you everything. And it's very important to have relationships with organizations so that you can ask them questions about the financial facts that are showing up on their financial documents. You can look at the kinds of assets and liabilities that an organization is showing on its balance sheet. Does it have a lot of liquid assets? Does it have a lot of cash? Is it in a good position if a big bill came due, or would it have to sell something? And that's important because if you have a lot of assets that are tied up in a building, for example, that doesn't help you pay the light bill. You can't use the building to pay the light bill. So you need to have adequate liquidity to meet your current liabilities at the very least. Does the organization have a lot of debt? Is it carrying a lot of debt on its balance sheet? And is that something that you think is a red flag? Or is it related to certain specific conditions that an organization might be going through? Maybe they just completed a capital campaign and they're dealing with some outstanding loans, but they will have paid those down over time. Does the organization have accounts receivable sufficient to meet its accounts payable? Is it expecting more money in soon, or does it sitting on a lot of bills that cannot be paid in the current period because the organization doesn't have enough accounts receivable to pay them? What's the balance of restricted and unrestricted net assets? An organization might, at the bottom line, have a positive balance of net assets, and it may have a substantial balance of net assets, but a lot of those assets may have restrictions on them that make them not as useful as they might be if they were unrestricted. I can use an example from GIA's history. We plan our conferences several years ahead, and we start raising money as soon as we can for a conference. So sometimes we have money that is restricted at the moment because we've raised it for next year's conference. Well, we had a pandemic and we got locked down in 2019 and 2020. And GIA had started fundraising for a conference in New York and a conference in Puerto Rico, and we had to postpone both of those conferences. We had money in our hands to use for both of those conferences, which was restricted money. We carried that on our balance sheet for a number of years because we couldn't do each of those conferences for 2 years. So for a number of years, GIA had a lot of net assets, a lot of which were restricted. We've released those assets because we held them for certain conferences that we ultimately were able to do. So our net assets have gone down over the last few years. If you look at a balance sheet from 2021 to 2020, actually, let's say 2022 to 2023, it would look like we're losing a lot of net assets and not replacing them. But that's because those net assets were never intended to be replaced. It isn't the current year that is the anomaly. It's the previous years where our net assets were very high. That's the sort of thing that you don't necessarily see when you just look at a balance sheet. That's why it's important to have a relationship with the organizations that you're funding or that you're considering funding so that you can find out these kinds of things. Another thing that you might want to find out is mortgages. An organization might have a mortgage that has a big balloon payment at the end, and that is not necessarily showing up as a big balloon payment on the balance sheet. You're just seeing how much is left to pay off on the mortgage. But it's helpful to know that because that big balloon payment might be 3 years down the road, and you kind of want to know if the organization is ready to make that big balloon payment. And you wouldn't know that unless you were able to talk to them about what's in your mortgage agreement. Context is everything. If you're able to look at an audited statement, the notes in the audited statement have lots of information that can tell you things like, is the revenue that that this organization received this year ordinary, or did they have a big windfall that is not going to be repeatable in the future? As I mentioned, explanation of mortgage arrangements. You can look at several years of balance sheets and P&Ls if possible, because that can show you trends. It can show you our expenses. I mean, expenses are always going up, but are they going up in a proportionate way or a disproportionate way? Is revenue coming down? Has the organization had consistent surpluses or deficits? And again, I'm going to refer back to our capitalization workshop. One of the things that we stress there is that healthy organizations should have consistent surpluses and should not be punished or penalized for posting consistent surpluses, because that allows them to build reserves that they can then use as needed if there is a revenue shortfall or an unexpected expense, or to build up reserves that allow them to make changes to their organization or take risks that they wouldn't be able to do if they were depending just on revenue. And as I said, most importantly, establish relationships with those you are funding or may fund. Nothing replaces a frank conversation about an organization's finances. So that is the discussion of the balance sheet. I'm just looking at some of the questions in the Q&A.
There's a couple of questions about in-kind, Champ, but you may want to wait and do that at the end and sort of come up and talk about how in-kind shows up on financial statements.
Yeah, let's hold that one till the end. We're getting close on time, so I just want to touch very quickly on the Form 990. Who doesn't love the IRS? This is a screenshot of the first page of GIA's Form 990. It's a tax form. It's long and complicated. The financial information that's on the 990 is more easily understood by looking at the balance sheet and or the P&L. So I'm not going to spend a lot of time looking at the financial information on the tax form. Even organizations that are tax exempt have to report to the IRS. Even if we're not paying taxes, we still need to file what the form is known as the 990. And in many cases, we also have to report to our state government, usually through the Attorney General's office. And usually, this is the case in New York State, there's a covering form, and we send them that covering form and our federal 990, and they're satisfied with that. What is useful about the 990 are some of the schedules that accompany it. So there's supporting information that is provided. On the form itself, the organization that's filing needs to put its mission. So you can see the mission of the organization right there. And it has to report on something called program service accomplishments, which are key program areas that execute the mission of the organization. So you have the three largest ones, including the expenses that are reported on the 990. So it's useful for looking at what an organization is spending the most on in terms of programming and what it considers its most important programs that support its mission. There's a schedule that includes a list of all the officers, directors, and key employees of an organization and how much they're compensated for. And there is a subsection of that that also includes the 5 highest paid independent contractors who are paid more than $100,000. So you can see who's on a board. You can see how much key employees are paid. You can see what the organization is spending more than $100,000 a year on. There is a schedule that lists all contributors to an organization that contribute $5,000 or more, which is useful information. There is a schedule that lists an organization's lobbying activities. And then there is supplemental financial statements, which is where you report on the value of art and historical collections, endowments, which we haven't touched on, but endowments are obviously an asset because it is money that the organization has. But typically endowments are restricted in that you can't use the principal, you can only use the revenue that is thrown off by investment of that endowment. And oftentimes it's only a percentage of that revenue. So endowments, while they can be a significant asset for an organization, are oftentimes not useful to an organization in terms of providing usable amounts of revenue. And Rebecca Thomas, the consultant that we work with on our capitalization workshops, goes into a lot more about the pros and cons of endowments in the capitalization workshop. And then there is, a supplemental information schedule that an organization can provide, and it can be useful to look at that to see what an organization thinks is important enough to report to the federal government. And then finally, the last of the documents that I just want to say something about is the cash flow statement, which is not useful as an evaluation tool. So if you're in a position to be looking at grantees or potential grantees, you wouldn't want to look at a cash flow statement, but just in the interest of completeness, I wanted to include it here. This is, you can see it's a very stretched, I apologize for the image, because it's a month by month document. Usually it's a rolling 1 year document. So when you finish May, you would cut off May and add it at the end, which is why this looks very stretched. It is typically 12-month rolling schedule of income expenses as they'll come in. So what the P&L and the balance sheet don't show you is when revenue is expected to come in and when expenses are expected to be incurred. And that's what a cash flow statement does. We know that we're launching a performance series in the fall. So we know we're going to get a bunch of ticket revenue then. So we can put it into our cash flow statement when we expect it to come in. We know that we're going to have a lot of expenses associated with that performance series, and we're actually going to incur those expenses in a lot of cases ahead of time. So we can put those in when we expect them to come in, and we can see, oh, we need to have some cash on hand before we start seeing ticket revenue because we're going to have expenses ahead of time. It allows an organization to anticipate when it's going to have tight cash flow and when it's going to be more flush. And it allows management to say, okay, looks like we're not going to have much cash in July. Maybe we can hold some bills back and pay them in September. Or maybe we can talk to a donor about giving us a gift earlier than they would have because we can use the cash then. Maybe we want to look at whether we have reserves and if we want to borrow some money from our reserves in June and then pay it back in November. That's the use of a cash flow statement or a cash flow projection. It's not particularly useful to anyone who is looking at an organization's fiscal health so much as it is for the organization's management. And that is the end of my presentation. Now let's go to Q&A. Okay. I'm looking at the Q&A and I'm going to go backwards from the most recent questions. Does the fiscal year beginning and end dates on a budget have to correspond with those displayed on the 990? No, it doesn't. In fact, your budget, your P&L, is not something that you send into the government with the 990. Typically, your accounting firm or whoever is preparing your 990 will analyze the finances to bring to show on the 990 the revenue and expenses relative to the period of the 990, which is generally a calendar year. Sometimes you can do a 990 for a fiscal year, but you have to make a special note that it is not the calendar year. If you have a contract for trade in kind contributions, should that be listed as an asset or listed as something different? It should be listed as an asset. In kind contributions, typically on a P&L are shown below the line because they are not cash. So you would list your revenue, you would list your expenses, you would list what the net is, your revenue minus your expenses. And then below the line, you would list the value of in-kind contributions. And then you can do a final or a grand total, where those in-kind contributions are factored into the P&L. At GIA, we do something similar with any gains or losses on our investments, because that is revenue for an organization. So we do report it on our P&L, but in the case of GNL, we're not actively trading on our investments. So it's unrealized gains or losses. It is useful to show as a factor on the P&L because it is part of what makes an organization function well or poorly. But because it's not real cash, it's listed below the line. And in kind is treated similarly because it's not actual cash, although it does have a value. I've seen on page 1 of some 990s the previous year's revenue and expenses listed. What would be a circumstance under which the previous year's revenue and expenses are not listed on the first page of the 990? I can speculate on some answers to that, but I can't say for certain. If an organization is brand new and it doesn't have a previous year that it can compare to, if an organization doesn't have access to its previous year's financial document, if there was some catastrophe where they may have lost those records, they might not list the previous year's revenue and expenses. Typically, it's required. So for an organization not to do it, there has to be some extraordinary circumstance. Is that budget template something GIA could create? There are some funders in the Bay Area trying to standardize grant applications, including budget forms, but it would be great if a national organization could initiate a standardized budget form. I mean, I would love to be able to do that. I would love to say who lives and who dies. But the fact is that most funders, particularly big funders, are very proprietary about their report forms and their applications. And GIA could develop one and ask them to use it, but they probably would not. I know that there are various localities that are trying to come up with a universal application, but they're meeting with mixed success because of that sort of proprietary nature. I don't know how many of the audience are in a position to affect any kind of change, but it would certainly be great if people were agitating for a standardization of financial reporting, just to make everybody's life a little bit easier. I see there's one more question in the chat. If remodeling extends the useful life of your property or improve beyond its original condition, you add an elevator to make a space ADA compliant, for example, they can be capitalized. Yes, there is a category that of asset that can be reported on a balance sheet called leaseholder improvements. What happens a lot of times is an organization rents a space and then makes physical changes to the space to make it more useful for them or more ADA compliant or just improve the space. And you can carry the value of those leaseholder improvements as an asset on your balance sheet. Again, you would have to have a depreciation schedule because it's a fixed asset. And it gets a little complicated when the organization leaves that space, because then it no longer has access to those leaseholder improvements, and they are no longer an asset for the organization. So they have to make an adjustment to their balance sheet. Can I speak to the seemingly abstract science of balance sheet with depreciation and how frequently it is used in for-profit, not-for-profit public entities? Yes. So a depreciation schedule is important to have to show on your balance sheet the true value of your fixed assets. The amount of depreciation for the current year is an expense for the P&L. So if your laptop computers are going to depreciate by $250 this year and be worth less than that next year, that $250 is an expense. But because it's not a real expense, it's not a bill that is invoiced and paid, many organizations, in fact, I would say most, don't report their depreciation expense on their P&L. For them to be fully transparent and fully fiscally sound, they should budget to cover that expense year after year. But most don't bother to report it or budget to cover it. And I have worked at organizations that don't. It's not an issue for GIA because we don't report fixed assets on our balance sheet. But that's what I meant in the slide where I said a lot of organizations don't use it. They don't show their depreciation, and they don't budget to cover it. But if they were really fully transparent, they would. And I think I'm going to stop there and turn it back over to Jamie.
Yeah, thank you so much, Champ. Thank you again. Thank you to Glenn. Thank you also to Jessica, our tech for the day. In closing, today's webinar has underscored the critical role that an organization's budgetary decisions play in reflecting its values and how funders like yourselves can assess and support those values. By aligning financial resources with long-term mission fulfillment, nonprofits can achieve financial health and vibrancy within their communities. We encourage you to further engage with this material by registering for GIA's Capitalization and Nonprofit Financial Health Workshop. Champ mentioned that a few times throughout his presentation, taking place on October 30th. Jess, if you could actually pull up that slide so folks can see the QR code. As funders and nonprofit leaders, it is essential to consider how we apply these principles to cultivate a stronger, healthier arts and culture ecosystem. GIA's collaboration with Rebecca Thomas and Associates, alongside advice from Sage Crump, highlights the importance of addressing the financial impacts of the pandemic through a racial equity lens. Moving forward, continued investment in capitalization knowledge, responsive support, and equitable practices is key to shaping a more vibrant and inclusive future for the arts and culture sector. We also encourage you to provide us with feedback about your experience through the survey link in the chat or using one of the QR codes on the screen. Webinar registrants, will also receive a follow-up email with a recording of today's webinar, as well as some resources. And I hope to catch many of you in person in Chicago at our conference in just a few short weeks. And with that, I wish you all a wonderful rest of your day. Thank you so much.
Jamie, can I just jump in real quickly? There are a couple of questions that are showing up now that we don't have time to answer, but since there's only 60 people in the room, I will say, feel free to email me if there are questions you still have, or things that were not clear, or questions that occur to you when you're looking at the slides. My email is available on the GIA website, and you can also see the details about all the amazing things that GIA is doing when you go there looking for my email.
Awesome. Thank you, everyone.